In 2007, Warren Buffett walked into a room full of the most powerful investors on Wall Street, and he made them a bet. He said, "I will put up $500,000. My bet is a single, boring index fund. Pick your best hedge funds, 10 years. Whoever wins, the money goes to charity." The hedge fund managers laughed. They had entire floors of analysts, proprietary algorithms, access to information most people never see. And this old man from Omaha wanted to bet against them with an index fund? They thought it was a joke. 10 years later, it wasn't. What happened over those 10 years is one of the most important stories in the history of investing. Not because it's about rich people and big numbers, but because the result of that bet is directly relevant to what you should be doing with your own money. By the end of this video, you'll understand exactly what happened, what it proved, and the one simple decision that most beginner investors get completely backwards, and how fixing it could be worth hundreds of thousands of dollars over your lifetime. Let's start at the beginning. Most people know the name Warren Buffett, but here's what matters for this story. Buffett is considered the greatest stock picker of all time. His company, Berkshire Hathaway, has beaten the stock market for decades by carefully choosing individual stocks. If anyone had the right to stand up and say professional investors can beat the market, it was him. But that's not what he believed. For years, Buffett had been saying something that Wall Street hated hearing. He kept saying that most professional money managers, the hedge funds, the active funds, the expensive advisors, were not worth what they charged, not because they were bad at their jobs, but because of a simple mathematical problem that very few people talk about: fees. Every fund charges a fee to manage your money. Some charge 1% per year, some charge 2%. Hedge funds often charge 2% of your total investment plus 20% of any profits they make. That sounds small until you run the math over time. Buffett's argument was this: even if a professional manager is genuinely skilled, the fees they charge eat so much of your return that the average investor ends up worse off than if they just bought a basic index fund and left it alone. Wall Street disagreed, loudly. So in 2006, Buffett decided to stop arguing. He decided to prove it. Buffett issued a public challenge. He would put up money on a simple S&P 500 index fund. Anyone who believed professional money managers could do better was welcome to bet against him. One firm took him up on it: Protégé Partners, a respected New York investment firm run by a man named Ted Saites. The terms were simple: 10 years, January 1st, 2008 to December 31st, 2017. Buffett's side, one fund, Vanguard's S&P 500 Index Fund. Saites' side, 5 funds of funds. These were funds that invested in dozens of the world's top hedge funds. In total, over 200 individual hedge fund managers. Each side put up money in advance. The total pot? $1 million, all going to charity. Before we talk about what happened, let's make sure we understand what these two things are. An index fund simply buys every stock in an index, like the S&P 500, which is the 500 largest companies in America, and holds them. No analysis, no managers making calls, no strategy. Just own everything all the time. The fee is almost zero. A hedge fund is the opposite. Teams of extremely smart people actively deciding what to buy, what to sell, when to move in and out of the market, charging high fees because they believe, and their clients believe, they can do better than average. Two different philosophies, 10 years to find out which one wins. The smart money was on Saites. The bet started on January 1st, 2008. What happened next couldn't have been scripted better for Saites' side. 2008 was the worst financial crisis since the Great Depression. The S&P 500 collapsed. By the end of the year, Buffett's index fund was down 37%. 37% gone. The hedge funds lost too, but only about 24% on average. In year one, the professionals had done exactly what they promised. They had limited the downside, protected their clients better than the passive fund. Hedge fund managers were feeling confident. But here's where the story gets interesting. From 2009 onward, the market recovered, and it recovered hard. The S&P 500 had one of the longest bull runs in history. Buffett's index fund captured every single point of that recovery, all of it, because it owned everything. It just rode the market back up. The hedge funds, they started missing out. The very strategies that protected them in 2008, holding cash, shorting certain positions, hedging against risk, Those same strategies slowed them down in the recovery. And then there were the fees. Every single year, 2% came off the top before investors saw a dollar. 20% of profits went to the managers. Compounding works both ways. Just as your returns compound upward over time, your fees compound against you. Every year you pay a fee, you lose that money, and you lose all the future growth that money would have generated. By 2012, Buffett's simple index fund had completely overtaken the hedge funds, 4 years into a 10-year bet, and it wasn't close. By 2015, the gap was so wide that Ted Seides did something remarkable. He didn't wait for the bet to officially end in 2017. He publicly conceded, a year early. When the dust settled at the end of 2017, here is what 10 years looked like. Warren Buffett's index fund, up 125.8%. The average of Seides' 5 hedge funds, up 36.3%. To put that in real money terms, if you had invested $100,000 with the hedge funds at the start of that bet, you'd have $136,000 10 years later. If you had invested that same $100,000 in Buffett's boring index fund, you'd have $225,000. Same starting money, same 10 years, an $89,000 difference from a single decision about which type of fund to use. The charity that received the winnings, Girls Inc. of Omaha, actually got more than $1 million because the money had been invested in Berkshire Hathaway stock while the bet was running. They received $2.2 million. The hedge fund industry had lost a public, 10-year, documented argument against a man who said fees matter more than skill. Now here's the thing most videos don't tell you. Buffett didn't win that bet because the hedge fund managers were incompetent. Some of them genuinely are skilled investors. Some genuinely do beat the market in certain years. He won because skill is not enough to overcome fees compounding against you over decades. Think about it this way. If a fund manager needs to earn, say, 12% a year just to match what their fees take from you, they need to be not just good, but consistently exceptional every year for decades, while dozens of other smart people are trying to do the same thing in the same market. Almost nobody does that. The data is clear. Over any 15-year period, roughly 90% of actively managed funds underperform a basic index fund after fees. Not because markets are easy to predict, because fees are guaranteed and outperformance is not. So what does this mean for you specifically? If you're starting to invest, the evidence, not just from this bet, but from decades of academic research, points in one direction. A simple, low-cost index fund that tracks the broad market, held for a long time with no tinkering. Not because it's exciting, because it works. Funds like VOO, which tracks the S&P 500, or VTI, which tracks the entire U.S. stock market. Expense ratios under 0.1%. No manager second-guessing himself. No 20% of your profits walking out the door. Just your money, growing with the market, year after year. The most boring investment in the world is also historically one of the best ones. Buffett knew that. He bet $1 million on it. And he was right.
In Buffett's 2016 shareholder letter, the year Seides conceded, Buffett paid Ted Seides a compliment for being willing to make the bet at all. And then he said this: the real losers were not Seides or the hedge fund managers. The real losers were the ordinary investors, whose money was in those funds, paying those fees, earning those returns. And most of them had no idea how much they were losing compared to the alternative. That's the whole reason this video exists. Now you know. If this helped you understand something you didn't before, subscribe. Every video on this channel is built around one simple goal: taking the things Wall Street makes complicated and showing you what actually matters. The next video covers one more fee that most ETF investors don't know they're paying, and how to spot it before it quietly costs you thousands. See you there.